Hello everyone. In this class, we are going to discuss the trading account, meaning of the trading account, why we need to prepare trading account, and the format of the trading. Let's start with the meaning. A trading account is a statement that shows the profit or loss a business makes from buying and selling of goods. Why we need to prepare a trading account? Every business organization purchases goods, incurs some expenses on them, and sells them to customer to earn profit. This process is known as trading activity. To know the result of this trading activities, we prepare a trading account. The result of the trading account can be either gross profit or gross loss. What do we mean by gross profit or gross loss? Gross profit or gross loss is the difference between net sales and cost of goods sold. So there is a formula for cost of goods sold. Cost of goods sold is equal to opening stock plus net purchases plus direct expenses and minus closing stock. Now, the meaning of net purchases, the cash purchases plus credit purchases minus purchase returns. Then you will get the value of net purchases. Direct expenses. Now, the meaning of direct expenses. Direct expenses are wages, carriage inwards, and freight, octroi. There are many direct expenses are there, like for making the trading account. We will discuss with the format. Now the question is how we get the gross loss and gross profit. If the selling price is more than the cost price, then it results in gross profit. If the selling price is less than the cost price, then it results in gross loss. Hi everyone. This is the format of the trading account. The heading of the trading account is trading account for the year ending on 31st March or on 31st December as per the company norms. So trading account format is like it has two sides, like debit side and the credit side. Debit side particulars amount, credit side particulars amount. And one more thing, trading account is nominal in nature. The nominal in nature means the nominal account rule is applicable here. So nominal account rule is debit all expenses and losses, credit all incomes and gains. So we have to write all the expenses here on the debit side, and the direct incomes we are going to write it here, like sales, then closing stock. This is the first stage of final accounts. Final accounts starts from the trading account. From the trading account, we will get to know the business is in profits or losses. So, with the help of trading account, we will get to know the gross profit or the gross loss from the trading activities. On the debit side, all the expenses are shown. On the credit side, all the incomes are shown. Incomes is nothing but these are the direct income. So there will be only sales and the closing stock. So here on the debit side, first it starts with the opening stock. This is the first item of the trading account. Opening stock is nothing but it is the beginning of the accounting year. It is for the beginning of the accounting year, the stock left over from the preceding year. The stock left over from the preceding year we will record as the opening stock. Okay, then after that we are going to write the purchase, how much purchases we have made during the whole accounting year. Like for example, cash purchases and the credit purchases from the supplier. Then altogether total purchases we have to write it here. Then we have to deduct the purchase returns. Purchase returns are nothing but like the defective goods or the damaged goods. We are returning it to the supplier. Why we return it to the supplier? Because that is not useful for the business. So all the purchase returns you are going to deduct from the purchases, total purchases. Then we will get the amount. The amount is called as the net purchases. Then after that, some purchase expenses are there. So purchase expenses are nothing but to bring those goods to the shop or go down or the business premises. Like purchase expenses are carriage, cartage, freight, custom duties, soft try, and there are many more purchase expenses are there to bring the goods safely to the business, from another city, from another country. The transportation charges are there. Those expenses are called as, or that is directly related to purchases, will be considered as the purchase. After the purchase expenses, direct expenses are there. Direct expenses to wages, factory rent, factory insurance, manufacturing expenses. There are many more direct expenses are there, which are related to factory and production related expenses are called as direct expenses. So wages, coming to the first point, wages are nothing but these are the payments made to the workers who are working in the factory for handling the goods, loading and unloading the goods. Factory rent is also there, and all these are considered as the expenses. Opening stock, first you have to record, then purchases, purchase returns, purchase expenses, all direct expenses. Make a total of this. All the credit side we have sales, total sales made by the company, cash sales and the credit sales. Now sales returns is nothing but the customers will return goods to us, and those goods are considered as the sales returns. So sales minus sales return, we will get the net sales value. We have to write it in the this column. Then by closing stock, what do you mean by closing stock? Closing stock is nothing but this is the leftover stock at the end of the accounting year is considered as the closing stock. After showing all the items on the debit side and on the credit side, like opening stock, purchases, purchase expenses, direct expenses, and on the credit side sales and the closing stock, after writing all this credit side and the debit side items, you have to calculate it. You have to make a total of the credit side, make a total of credit side, make a total of debit side. Like for example, credit side amount is 1 lakh rupees and the debit side amount is 80,000 altogether, everything like opening stock. So from here till here, all the calculation you have to make. Like if we got the total of credit side 1 lakh rupees and the debit side total is 80,000, then the 20,000 will be the gross profit. This is the gross profit, and this is going to be transferred to the P&L account. Like in case vice versa, if the debit side amount is more than the credit side, the business will be in the losses. So the business is in gross loss. So with this amount we have to transfer it to the again profit and loss account.